Good morning, campers. What I want to talk to you about, top of the morning. I got my coffee ready to go. Top of the morning. What I want to talk to you today about is the 2% rule. I don't want any of you putting more than 2% in any one of these companies. If you're investing in a similar portfolio to the one I've been showing you, at most 2% any one companies. And that's 2% of your total net worth or your adjusted net worth, your total net worth less the value of the house you're living in. So, for example, and it's your liquid net worth. So if you bought a new car for $50,000, it's sitting outside. It's not worth $50,000. It's worth maybe $40,000. So count that as $40,000. But you can count it. If you have some rental property and the rental property is worth, say, $1 million and you owe $800,000 on it, you don't have $200,000 in value. You have $1 million minus 8 less the cost to do the transaction. And for real estate, I like to use 10%. I think that's a little high. So if you take $1 million property, you might spend $100,000 in selling it. And then at $800,000, that's 200 minus 1 is $100,000. So your net worth, so the contribution to that, your net worth is $100,000. If you have, say, $100,000 in a brokerage account and $100,000 in $100,000 in a brokerage account and $100,000 in a IRA, you don't have $200,000 in your net worth because that IRA you haven't paid taxes on. So the $100,000 in the brokerage account is worth $100,000. The $100,000 in the IRA is only worth, I would count it at 80%, so 20% for taxes. As a good estimate, I would count that at $80,000. So the contribution to your net worth is $180,000. And then why the 2% rule? I had this conversation with a financial buddy of mine, and he said, it's a 5% rule. You should be able to put 5% in any one company. No, not the companies we're talking about. If you're talking about Apple, that's great. Apple's got real value, it's got assets, and it's got revenue. Most of the companies we're looking at here have got some debt, so there's some debt service, and the debt service is what's going to kill them because they have to pay that. And then typically there's little or no revenue in these. These are all pre-revenue. That's part of the reason they pop so much. It's just we're looking for ones that have potential. They've come up with a good enough argument that they've got some value there. Other people think they're value, and that's how we find them. And when they pop huge. But part of that is they're super risky. So let's keep that down to 2%. 2% for any one company. So you'll see I'm trading a portfolio of, I've got $100,000 and I've got 12 companies, call it 10, just to make the math easy. How much money should I have net worth to be trading this exact portfolio? I would argue it's probably around $2 million. How did I get that? So if I had $1 million of total net worth, so that's my total add up, my liquid value of all my assets, take out the house because I got to live in a house, so that doesn't count. If I've got $1 million, 2% of $1 million is $20,000. So I don't want to have more than $20,000 in any one company. And these companies will tend to pop. So we're buying 10,000 of each of these companies roughly. So with that would make sense because the company's going to grow from 10, ideally up. They will shoot beyond 20,000 and we're going to sell them. But you could end up with 20,000 in one of these companies, so that would be appropriate if you had $1 million. Now, I say $2 million because you need to have a diversified portfolio, and you don't want your whole portfolio to be like these type of things. You want maybe 10% of your portfolio to be high-risk assets like these. So 10% of $1 million is $100,000, except because of the 2% rule, you're only going to buy 5 of them, and we're into 10 of them, so you need $2 million. So just to keep your portfolio diversified. So you need to have a diversified portfolio into lots of stocks. The easiest thing is mutual funds or ETFs. And then if you trade stuff like this on the side, it potentially will greatly enhance your value of your portfolio, but you don't want to have too much, not too much, 2%. I will refer to this video often, and I will refer to the 2% rule, but it's total net worth, liquid net worth, take out the value of your house, and 2% in any one stock at any one time. So do that math, keep the holdings in any one stock below that, and you'll do much better in the long run. Much better in the long run. Okay, thank you.